start talking about trading divergence. Now, before we get started, I want to mention a couple things. First of all, if you notice on your screen, there are 3 handouts I prepared for you. Now, these handouts are only available in tonight's class. Okay. You have a complete guide to Introduction to Technical Analysis, which will cover the entire range of all oscillators and indicators, as well as chart patterns, support and resistance, and trend lines. You also have a handout guide on trading divergence, which gives you a little bit more detail about what we're talking in class tonight, with charts and examples, so you can help understand better what divergence is and how to apply it. And then you have a handout in understanding the different types of technical indicators, so that you can understand which ones would work best for you and which ones duplicate each other, so they're just redundant in your trading system. It explains to you which ones are lagging, which ones are leading, and which ones work well with divergence. So please click on the download buttons and download each one of these now, because they won't be available at any other time. So in the recorded version, you cannot click at the download buttons. So make sure you download them now. Now, also in tonight's class, I use the term security when referring to any tradable instrument, whether we're talking about stocks, bonds, commodities, futures, indices, mutual funds, options, CFDs, or even cryptocurrency. While I may imply a specific investment product, like I might say Bitcoin, or I might say Apple, I'm referring to the general fields. Okay, it just gets very, very boring saying security, security, security. So I try to, give you some other terms so we don't sound so boring. Same thing with investing and trading. Now, divergence works best for traders. And we understand trading is a short-term, we're short-term position traders taking advantage of short-term moves in the market. But sometimes I say investing, and I understand that you understand investing is a more long-term position, and investing and trading are different. But again, I use the words interchangeably because divergence works in both markets or both cases, and it gets very boring just saying trading, trading, trading. Now, the ultimate question you're asking yourself is, should I buy or sell today? What will the prices be tomorrow, next week, or next year? Now, wouldn't investing be easy if we knew the answer to these seemingly simple questions? But alas, I don't have a crystal ball. I don't have a Ouija board. So if you're attending tonight's class in the hopes that technical analysis has the answer to these questions, I'm afraid I must disappoint you. However, if you're attending this webinar with the hopes that technical analysis, especially trading divergence, will improve your investing or trading, then I have good news for you. It will do that. Now, in the Forex markets, or for that matter, even futures or stocks, divergence is often related to the price and the oscillator that it is tracking the price. Divergence can be spotted by use of oscillators such as RSI, Stochastics, MACD, and used in conjunction with price. So when the oscillator is usually moving in one direction, but the price is moving in the other direction, they're said to be diverging. So an oscillator falls in the field of technical analysis, falls under the field of technical indicators. That's why I gave you the handbook on technical indicators. And an oscillator is an indicator which moves between overbought and oversold levels. And it oscillates. It moves up and down, because most oscillators are based on price and the relative momentum or volume. Oscillators are the best choice for understanding momentum in prices, which signals how strong the prevailing market trend is. When prices reverse or retrace, the oscillator tends to follow them in the same pattern. So here, let me pop up a chart, and we'll show you this on a real live chart. Okay, so we're looking at MACD on this chart. We're looking at RSI and the Euro US dollar. And if you're not sure about technical indicators, you should come to our class on technical analysis. But we can see at this point, prices are moving up while the indicator is also moving up. They are moving in conjunction with each other. But now here we have an interesting scenario. Price is continuing to move up while the indicator is moving down. So what do we have? We have divergence, and that's telling us something about the price when our indicator is moving in the opposite direction of our price action. Because normally we would expect them to move in the same direction. Not with the same exact movements and not to duplicate their movements, but at least in the same direction where the oscillator is making higher highs while the price is still making higher highs. We don't expect the oscillator to be making lower highs while price is still moving up. So when price reverses or retraces, the oscillator tends to follow the same pattern. Therefore, when prices are making higher highs or higher lows, the oscillator tends to mimic the same pattern. But conversely, when prices are making lower highs and lower lows, the oscillator tends to print the corresponding lower highs and lower levels. This is what we all know as convergence. Convergence is when they converge, they move in the same direction. Divergence is when they start moving in opposite directions. So when price makes a high or a low and the oscillator fails to confirm the same, it is known as divergence. By spotting these divergences, traders are usually signaled to a potential change in the direction of price. So when we get these divergences, it's telling us that something isn't right about price action and the current trend is losing its momentum, or we're going to get a reversal. Uh-oh, sorry about that. Now, divergence are formed when there is a mismatch between the price action and the momentum, measured by the oscillator relative to price. Quite often, you will notice that divergence tends to occur near support or resistance levels. Now, we're talking about oscillators in generality because there are literally hundreds of them. And divergence is a state of action that doesn't matter which oscillator you're using, because oscillators fall into a standard explanation, whether you're using one that uses a 0 to 100 or you're using one that uses like MACD that uses 0 lines and minus ones and twos. It's still the movement of the two that diverge or converge together. So it's up to you to decide what oscillators you wish to use and how you're going to use them on your charts. Its divergence occurs only on a unique movement between the oscillator you're using and price. So therefore, divergence trading can be used not only to time the entry into a trade within a trend, but also helps you understand support and resistance levels. While divergence are broadly classified into 4 types, the underlying theme among the 4 types of divergence is that it shows price exhaustion when the oscillator fails to confirm the new highs or the lows. Divergence takes place all the time across all the time frames. However, the best results come when the divergence is spotted in a higher time frame, such as a 4-hour session or higher, when you're trading in short-term trading. Now, one of the most common mistakes often made with divergence trading is that traders expect the price to behave in a certain manner when a divergence is spotted. This is wrong. Just because a divergence has formed doesn't mean that the price will reverse. In the charts shown, we're going to show you several charts in a minute, you'll find a few divergence setups where price moved in the opposite direction, contrary to the divergence was telling you. It is therefore important to understand that traders should look for other confirmation tools before trading divergence setups. So divergence comes in 4 different categories. Okay. We have regular or classic divergence, and then what's called hidden divergence. With each of these two categories, you have a bullish and a bearish. So we have regular bullish divergence, regular bearish divergence. We have hidden bullish divergence and hidden bearish divergence. These are just the names. We'll talk about what they are and how to spot them in a second. So they just mirror reflection. The regular bullish or classic bullish divergence and classic bearish divergence are just the opposite one another. Hidden bullish divergence and hidden bearish divergence are exactly the mirror images of each other. So the four types of divergence, regular bearish divergence occurs when the price is moving up and the oscillator is moving down. Regular bullish divergence happens when price is moving down and the indicator is moving up. So if we talk about price moving down, that means it's moving into a downtrend. And the bullish and the indicator is making higher highs while the price is making lower highs. Hidden divergence gives us the opposite of each other also in the opposite directions. So in other words, when price is moving down and the divergence is moving up, we have hidden bearish divergence, and we have hidden bullish divergence when the price is moving down up and the indicator is moving down. Now, if you notice on the chart you see in front of you, we're based it on the 5 waves of price movement in a trend. Move 1, 2, 3, 4, and 5. So we see the hidden divergence between 1 and 3, while the indicator is between 2 and 4. So what we expect is when the price is making highs and then higher highs, but the oscillator is making high and then a lower high, we have regular bearish divergence. When the price is making a low and then a lower low, while the indicator is making a low and a higher low, then we have regular bullish divergence. Okay. Now, the difference comes when you have a high making a lower high, which is the same as you get in regular divergence, but the oscillator makes a high and then a higher high. And you get also in the hidden bullish divergence, you have a, let me just get my marker on here and see if this will make it clear. Okay. This and this are relatively the same. The biggest difference is in your oscillator reading. And your trend line. So here we're making higher, we have a high, and then we're moving into a higher high as we would in a standard uptrend, but our indicator is moving from a high to a lower high. And then with the hidden divergence, we move from a high in an uptrend, but we made a lower high, while our indicator made a high and a higher high. It's a very fine difference. It's hard to spot, but it is a fine variance in how we would interpret this. With our bullish divergence and our regular, we have a low and then a lower low. So in other words, you have price moving down here, makes a low and then a lower low, while our indicator is making a low and a higher low. And don't worry, we're going to show it to you in examples in a second. So a regular divergence is used as a possible sign of a trend pause or a trend reversal. So a regular bullish divergence occurs when the price is making lower lows, but the oscillator is making higher lows. Usually this happens at the end of a downtrend. Price and momentum are expected to move in line with each other. If the price makes a new low, but the oscillator fails to make such a new low itself, it is likely that the price will retrace or even reverse. The opposite is true of regular bullish divergence, which happens when the price is making a higher high, but the oscillator is making a lower high. This type of divergence can be found in an uptrend. When such a divergence occurs, price will most likely retrace or reverse. So they're the exact opposite of each other. One happens in an uptrend, the other happens in a downtrend. So divergence and convergence can be measured, can be used in a multiple of manners. When the currency is diverging, the likelihood of the trend continuation is decreasing and a trend reversal is possible. When the currency is converging, the likelihood of trend continuation is high and trend reversal is unlikely. So in other words, when we have diversion, we're likely seeing a trend reversal. And the continuation of that trend is getting less and less probable. When we have convergence, that means they're moving the same direction, we have a very strong likelihood that trend will continue, and a trend reversal is unlikely. When the currency is doubled or tripled divergence, the likelihood of a trend continuation is unlikely, and a trend reversal is a decent probability. So the oscillator indicates to us that momentum is possibly shifting, and even though price has made a new peak or bottom, the chances of the momentum being sustained and continuing are decreasing. Regular divergence is useful for cautiously predicting the end of a trend, but only in some cases with the currency pair totally reverse of a trend in the opposite direction. May I emphasize the word cautious in the previous sentence. It is a tricky trading element to master and is always beneficial to add other methods of confirming a potential trend. So let's go back and look at a live chart again. Okay, so on this chart, we have RSI. Okay, and you can see RSI is an indicator, a bounded indicator that moves between 0 and 100. Okay, we don't care what its calculation is. We don't even care what it's telling you because we're not reading RSI. What we're looking for is the divergence or convergence of the overall move of the RSI and its subsequent move in price action. Now, RSI has a whole bunch of other interpretations because it wasn't developed for divergence and convergence. It tells us something when the price is above the 70 line, telling us the asset is oversold, and below the 30 line is telling the asset is overbought. I'm sorry, it's oversold below 30 and overbought above 80. And it's got a 50 line that helps us see what's happening here. But that's RSI. If we were to change this to another oscillator, let's get this off of our charts, and we'll add stochastics on here. We have the same exact thing. Different calculations, different interpretations, different use, but we can still add the highs and the lows of the indicator and compare that to the highs and the lows of price. If we were to take this off here and add MACD on, okay, now all of these are calculated different and do different and tell us different things and have different strategies, but ultimately they are indicators that go on the bottom of our chart. Okay, so I'm going to take this. Well, we can actually leave the histogram because we can see divergence and convergence with the histogram as well as with the MACD line below, because all we're looking for is when these two lines, when the line of the indicator, we can call it the trend of the indicator, is making higher highs while the indicator is, while the price action is making lower highs. Because you can see how these indicators actually kind of move with price. So the name of this pattern speaks of its character. We have divergence when the price movement is contrary to the indicator movement. Now, this type of regular divergence comes in two forms. Okay. We have bullish and bearish divergence, and they are exactly the same, except one exists from downtrends and one exists for uptrends. When price is making higher highs and higher lows, then we would expect the indicator to do the same. If it's diverging, we expect the indicator to do the opposite. So bearish divergence, this is when price creates higher tops on a chart, while the indicator is giving you lower tops. So another bearish divergence isn't during a downtrend, it's during an uptrend. This uptrend is moving up, so it's making continuous higher tops, higher highs. But what's happening is the indicator isn't giving you the same higher highs, it's making lower tops. It can be moving in the same direction, but it's got a trend line that's technically moving down. So after a bearish divergence, price usually makes a rapid bearish move. So an indicator diverges negatively, we would expect price to at some time waver and drop. Bullish divergence is just the opposite. Bullish divergence occurs in a downtrend when the indicator is making the opposite direction, and we would expect that price then to rally. So the bullish divergence has absolutely the same characteristics as bearish divergence, but in the opposite direction. So here on this chart, we can see it very plainly and clearly. Here we see price making higher highs. We could actually extend a trend line, even though it's not a valid trend line because we don't have 3 points, but we can see prices making a higher highs. But look at the indicator. The indicator is making lower highs. Here we have price making lower lows and moving in a downtrend, where the indicator at the same time is making higher highs. Here we have price moving in an uptrend, making higher highs, while the indicator itself, even though it's moving up and down, it's the peaks that we're looking at, and those peaks are making lower lows. So it's moving the opposite direction of the price trend. So again, we can see it right here. Price is moving down, making lower highs, lower lows, or I'm sorry, higher lows, lower lows. Price here forms a low, forms down here and makes a lower low, while the tops of our indicator are making a low and then a higher low or a higher high. So it's moving in the opposite direction of price. Now, how to use regular divergence and convergence. There is no divergence or bad divergence between these similar humps, as price must go back to the zero line for proper divergence analysis. So you need to look at your indicator. In this case, we're looking at an indicator that's a histogram above and below a zero line. Okay. In other words, we're looking at something like MACD. Okay. So this is slightly different than looking at stochastics or RSI. We're looking at the histogram, but you can still see the histogram is making higher highs while the price is making lower lows. Now, one method for analyzing divergence with a different perspective is by using trend lines and trend channels. Once divergence occurs in the market, the single line trend lines can identify when a trend is ending and may signal the end of a trend. Waiting for that break could be one of the ways of trading divergence. Because see, divergence only is an alert. It's telling you that trend is in trouble. It's telling the trend will most likely reverse. It doesn't tell you entry points and exit points. It doesn't tell you stop loss and take profit points. It tells you simply that the momentum is waning, and if you're in an asset, you should be looking it out. If you're looking for a buy opportunity or sell opportunity, they should be coming close. So another important point is by managing expectations with regards to divergence. There is a substantial difference between a pip size of a reversal and a retracement. Be careful to reckon and plan on both in your trading. Now, I've explained all this in great detail in your handout. I'm going to share with you right now a short presentation on divergence with RSI so that you can see it working together. And then we'll come back and talk about this a wee bit more. So we have discussed the different types of divergent patterns and some reliable indicators to trade with divergence, especially RSI, Stochastics, MACD, CCI. There are many of them. Most of them fall into the category of momentum indicators or overbought and oversold indicators. But now we know how to spot divergence. We need to know how to enter the market on divergence. However, before you start trading divergence setups, there are a few more points that we need to discuss further. These things include an example money management approach when trading divergence setups. If you do not have sound money management plan, you are likely to lose money trading divergence or any other setup for that matter. So you can use divergence to place your stop loss. Regardless of your trading method you use, you should always place a stop loss for each of your trades. It's no different when you trade divergence. And for most traders, it's best to place a hard stop in the market instead of using a mental stop. So in other words, place your stop loss as part of your order entry. Now, as far as divergence setups go, one way to place your stop loss would be to put it right above the last top on your charts, which confirms the bearish divergence. If the divergence is bullish, then we rely on bottoms and the stop should be placed below the last bottom on your chart. So you can see examples on this chart in front of you. Now I've included this same chart in your handouts and a step-by-step process in the handout I gave you, Trading Divergence Guide. So you should also always have strict take profit rules when trading divergence. For all the positives of trading divergence, one of the things that divergence trading does not offer us are clear targets. Therefore, an additional tool should be used in order to select your profit targets. Typically, if you trade divergence with RSI or stochastics, you may need an additional indicator to close your trades. However, if you're using MACD, then you can fully rely on this indicator alone. The reason for this is that MACD is a lagging indicator and it is a good standalone tool for exits as well as entries. My preferred method is to use swing analysis and support and resistance levels for trade management and profit targets setting. However, as I've just mentioned, MACD is a viable option. And if you're not sure about MACD, we have an entire class just on MACD. It's a great indicator that serves many different purposes. So MACD is made up of the histogram, the slow line, which is called the trigger line, the fast line, which is called the MACD line, and when they cross over, they give us entry signals. So when we see divergence or divergence with these, they are also being confirmed by the crossovers that give us the buy and sell signals or the transaction signals in MACD. So we have all the tools we need in order to put Forex divergence trading plans together. So let's now combine all these rules and see how this would work. We will use the MACD indicator for spotting divergence and for closing trades. So as you can see on the chart, we have down below, we have our MACD crossover. At the same time, we have divergence. So when we get the crossover is our transaction signal. Transaction signals are triggered in or happen in MACD when the trigger line crosses the MACD line. So that gives us a buy signal that's confirmed by the divergence, and then we would put our stop loss at the lowest candle, and we would project our target point based on the previous move, and then we would put our close and our exit point when we got our next stop crossover with the MACD. So as we discussed various types of divergence, the indicator that can be used to trade them all and also some trade management techniques can be employed within a divergence strategy. This should be a good base from which you can create and start testing out a divergence method of your own. Now, in the handout and also in the little class, the presentation, we discussed using MACD with RSI, and they are a very, very good combination. So understanding when your indicator is high or low is important when it comes to interpreting divergence. And I generally encourage traders to look beyond the squiggly lines of their indicators to explore what it really means. Typically, the RSI makes higher highs during healthy and strong bullish trends. This means that there were more and larger bullish candles in the most recent trend wave and that they are compared with the previous wave. Classical technical analysis tells us that a trend exists when price makes higher highs. But like too often, conventional wisdom is seldom right and usually simplifies things too much. A trader who only relies on highs and lows for his price analysis often misses important clues and does not fully understand the market dynamics. Even though a trend could look healthy at first glance, that means it's making higher highs and higher lows, it might be losing momentum at the same time. So when we look deeper at the candles and the momentum, you might see something that gives you a better opportunity. Now, I'm a pure reversal trader, and early trend trades after divergence are my bread and butter. So to sum it up, a divergence setup is a leading pattern giving us an early entry into emerging price moves. Divergence trading is an effective method and allows traders to combine price action and indicator analysis into a trading strategy. Remember, there are 4 types of divergence: regular bullish divergence, regular bearish divergence, hidden bullish divergence, and hidden bearish divergence. Some of the most reliable indicators to use to find divergence are MACD, RSI, Stochastics, and Bollinger Bands. But remember, a sound money management plan is required for trading Forex divergence or any strategy for that matter. Divergence signals do not provide clear profit targets. We do not know how far a price is likely to go once they reverse. So in many cases, we have to utilize other techniques to exit our divergence trade setups. The MACD is a good standalone tool for trading Forex divergence. When you trade divergence with MACD, it can be used to provide you entry as well as exit signals. It's important to remember that most trading approaches reliant upon divergence are based on correlations between momentum oscillators and an individual security's price action. In the event that a security is in the midst of a strong trend, momentum oscillators can provide false and counter trend signals. Conversely, when a market enters a consolidation phase, the lack of sufficient price action may lead to a scarcity of clear-cut signals. Being aware of the current market state is imperative to a trader incorporating divergence into his or her trading approach. Ultimately, divergence is best utilized as a tool for confirmation and should be used to make trading decisions in concert with other aspects of technical and fundamental analysis. So on that note, I'm going to say goodnight to everybody. Please, before I close off the webinar, click on the download button and download those 3 handouts that I gave you. And remember, you can see a recorded version of this class by using the same link you used to come to tonight's class. So I'll give you a minute to click those download buttons and get those things downloaded. And we'll see you again tomorrow night. I have no idea what I'm teaching tomorrow, but we'll see you again tomorrow night. And if you have any questions, go to www.legacyfx.com. Go over to their education section, and they're going to have all types of information on oscillators and indicators, as well as divergence. So have a great trading night, and thank you very much for joining us. Bye now.